We detected an unusual trade worth $1.5 million on BP stock. This is one of the largest oil companies in the world. Now, what makes this even more interesting isn't just the size of the trade, it's the timing. Tensions are rising quickly in the Middle East, with reports of attacks between Israel and Iran. Historically, whenever conflict erupts in that region, oil prices can spike, creating major opportunities in oil stocks like BP. Speaking of oil stocks, if you're one of our members, you would know that we bought another oil stock, Schlumberger, earlier this week on Monday, June 9th, even before the attacks happened in the Middle East. This was the video analysis from June 9th that we shared with members only, where we broke down the data to show why we were going long bullish on Schlumberger. If you want to see exactly how we got into this oil stock early, we'll link this video at the top. It's a great preview of the kind of content you get inside our membership. Now, that trade is already showing strong profits because oil prices surged this week, marking their best week of the year. And so, this is exactly what we mean when we say smart, wealthy investors often have deeper market insight to make more informed financial decisions, allowing them to stay one step ahead before the rest of the market catches on. And that is why we track their trades to increase our chances of profit by getting into the same stocks early. So if you're tired of being late and want more time to act on these opportunities, just head over to our website. We'll put a link up here so you can see in real time when and which stocks wealthy investors are trading on Wall Street so that you can have the same opportunities as the rich. Because if the rich get richer, why shouldn't you? Now, with that in mind, let's break down the latest data to find out if this wealthy investor is still bullish and buying oil stocks like BP or turning bearish and selling before it drops lower. And so, as we can see here on the options time and sales tape, the most unusual trades happened on June 13th at 12:24 at the 48-second mark for the September 19 options at the 33 strike calls and the July 18 options at the 24 strike calls. Now, we need to be very careful with these 7,000 contracts being traded for the July 18 options because when we dive deeper into the option chain for the July 18 options at the 24 strike calls, we have an open interest of 7,120 open contracts, slightly more than the 7,000 contracts being traded at the volume. And based on our analysis, this wealthy investor closed these options but opened new options at another expiration date, September 19th, by using an options rolling strategy. As we can see here for the September 19 options, at the 33 strike calls, we only have 1,321 open contracts here, much less than the new contracts being traded at the volume. So we know these contracts were new opening trades because it would not be possible to close out so many of these contracts if only 1,000 open contracts existed. And so, if we go back to the options time and sales tape, this wealthy investor was closing out of these July 18 options at the 24 strike calls and rolling them to a higher strike price and a later expiration date. This means that these September 19 options at the 33 strike calls are the new open trades. And so we can calculate the cost of this new trade by multiplying the total number of contracts by the price per contract, which is 113. Keep in mind that options are priced per share, and each options contract represents 100 shares of stock. So we multiply by 100 or simply move the decimal 2 places to the right. That means each contract costs $113. And so when we multiply this by 14,000 contracts, we get a total trade value of approximately $1.5 million for this unusual option activity. But keep in mind, oil prices have already moved up, and much of the Middle East tension may already be priced in. That makes this a higher risk trade compared to the trades that we share on our website. And so if you want to get access to the lower risk trades with a higher probability of profit, then go to our website. We'll put a link up here. Now, even though this trade carries higher risk, we still took it, but we used position sizing to manage our risk. As you can see here on the option chain, for the September 19 options at the 33 strike calls, since this was a new opening trade, we also traded these call options and got into the same position here. POS stands for our position, and the green color means a buy position, because based on our deep research across multiple variables and data sets, this wealthy investor bought these 33 strike calls for 113 each, the same price as we calculated and saw earlier on the options time and sales tape. And so when we analyze this trade, you can see here on the risk profile graph where the profit or loss shows up here, and the x-axis represents the share price of the stock, which is currently trading over here, and the y-axis represents the amount of profit or loss. Note the zero break-even line here. And so when the purple line, which represents the current date, and the blue line, which represents the option's expiration date, are trading below this zero break-even line, as the share price goes down, this trade becomes more negative loss. And as the share price goes up, this trade becomes more positive, more profitable, because it's going long bullish on BP stock. We can also confirm that by checking the options Greeks. This trade has a positive delta, which means it's positioned long and bullish. If it was a short bearish trade, we would see a negative delta instead. But keep in mind the risk with this trade. It has a negative theta, which means it loses value over time due to time decay. And that is why you can see here the purple line drops down lower to the blue line as we approach the option's expiration date. Since these options lose value through time, the break-even on this trade moves higher as time goes on. And so you can see here, even though the call options we bought have a strike price of $33, the stock needs to trade above $34 per share for this trade to be profitable at expiration. Because of this added risk, along with other factors, we only took a small position in this trade. We don't invest a lot of capital into these higher risk trades. Instead, we focus most of our capital on lower risk, higher probability of profit trades, the kind of trades we share on our website. We'll put a link to our website here, where you can also learn more strategies to increase your profits. And if you want a sneak peek at our membership trade on another oil stock earlier this week before oil prices surged, we'll link our Schlumberger trade over here. Let us know in the comments, do you think BP stock will go up or down? As always, please like, subscribe, and until next time, let's keep tracking the trades of the rich so everyday investors can profit too. Take care and have a wonderful day.